Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to take a look at two cheap dividend paying companies that may be a great buy right now for some growing passive income into your portfolio every single quarter. And as the market trades near all-time highs and companies continue to see sky-high valuations, it might be a nice opportunity to buy some blue chip dividend paying companies that are trading at low forward PE ratios at this current point in time. So in this episode, we're going to go over two blue chip companies. They operate in very different sectors of the market, so owning both of these names in a portfolio can provide some great diversification with some growing passive income every single year as well. So before we jump into the first company, I'm going to ask you to please hit that like button and subscribe. I'm the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for the daily videos, and of course today we're going to focus on two blue chip dividend paying companies that are trading at low valuations at this current point in time. And the first company we're going to discuss in detail is ticker ABBV, which is Abbvie. They trade for $115 per share and are up by 17% on the 1-year chart. This is a big pharma giant that has a current market cap just below $200 billion and a nice high dividend yield of 4.5%. And right now the overall S&P 500 is trading with a forward PE ratio of 22, which is well above its historical average. And in comparison, Abbvie and this big pharma player currently sits with a forward PE ratio of only 9, so might be providing a ton of value at this current price point. So definitely a high dividend paying company to take a look at for your portfolio to get some growing passive income every single quarter with a nice high starting yield above 4.5% and some long-term capital appreciation to bolster up your total return. And if we take a look at this company's investor presentation, they're a big pharma player operating in multiple different sectors of the industry, and they have market-leading products across multiple different subsectors as well. They own the number one selling product in 5 different consumer categories, and within each, they pretty much control more than 50% of the respective market share, which is absolutely phenomenal. And going forward, this company believes they will continue to grow. They have a massive pipeline of drugs in development across all the different consumer categories, and they have 2 main products that they believe by 2025 will generate over $15 billion of global sales, which would be absolutely phenomenal, really bolstering up the company's total top line. And they believe through 2025 to 2030, these 2 products will dominate the market, bringing in tens of billions of dollars of total revenue and income year after year. And if we take a look at the recent financial history, the company has seen some incredible performance since it was spun off from its parent company back in 2013. Their adjusted net revenue growth is over 13% per year. They're growing their annual earnings per share by close to 19% annually as well. And the total shareholder return since 2013 has been over 342%. And this is a massive dividend growth company as well, and their annual dividend payment has grown 225% since 2013, which is absolutely remarkable. And of course, with every company on the market, they have their pros and their cons. And it's always important to take both factors into consideration when evaluating a dividend paying company. And right now with Abbvie, there's 2 main cons going along with this business. The first is that their market-leading product Humira, which generates 40% of their revenue, is losing patent protection in 2023. The second is after their recent acquisitions, the company does have a lot of debt on the balance sheet, which they have to bring down. So those are the 2 key items that are keeping many investors away from Abbvie stock, and I completely understand. There are definitely some red flags that would hold off an investor from buying into some shares of this big pharma giant. But if we take a look at some analyst reports and some market research, some of the largest and most credible investment firms in the world and different analysts do believe that Abbvie will continue to grow through this time period without any harsh declines. Although they are all forecasting major decline in Humira sales, they're predicting that Abbvie's other products will bring up their total revenue and their income, so the overall business, the top and bottom line, is not going to see as bad of a decline as some people are expecting. And if we take a look first at 2 Morningstar reports, I believe Morningstar is a very conservative market research firm. They don't give any very bullish or bearish expectations, and I think their entire mission is to stay somewhat in the middle. So if we take a look at this report that was published on February 4th, 2021, so before we have any Q1 numbers for this calendar year, the title reads, Abbvie's next generation drugs will help mitigate the Humira biosimilar pressure in 2023. So right now, they're expecting that all the other drugs in Abbvie's pipeline will generate enough revenue to help the company continue to grow, even though Humira will lose patent protection in 2023. And reading through this article, they list some key points discussing all the different options, different products within the Abbvie umbrella and the recent acquisitions, which should help the company maintain and surpass their current levels over the next few years. And if we take a look at a second article that was published after the Q1 report on April 30th, 2021, Abbvie started this calendar year with some incredible financial numbers, and the headline reads, Abbvie posts solid Q1 as new drugs look increasingly well-positioned to mitigate Humira generics. So that means all the competitors who are going to enter into the Humira space take down that single product's market share and hurt Abbvie's top and bottom line that way. The other products are looking very strong and should maintain the current levels and actually allow the company to surpass where they are today over the longer term. So these are definitely some very positive articles for Abbvie coming from Morningstar that kind of give a positive view on the situation, and that the other drugs in the pipeline are going to help make the blow from the Humira loss not as bad as what some people were initially predicting. And if we take a look at right now, this company has a massive yield of 4.5%. Their annual payout is $5.20 per share, and they have a net income payout ratio of only 41%, with a 5-year dividend CAGR of 18% per year, which is absolutely remarkable. And another reason I consider them for this video is because according to Simply Safe Dividends, their current dividend is considered safe. It's coming in at a 70, meaning over the shorter term, we're not expecting a dividend cut to come from this big pharma giant. And their last dividend increase was 10%, which is a great sign that they continue to raise their dividend by such a fast rate. And one thing that I want to share is a positive. Even throughout the entire Humira loss, even through the inflated debt level, this company actually got a raise to their dividend safety score from 50, which is considered borderline safe, up to a 70 on May 3rd, 2021. So just recently, Simply Safe Dividends upgraded and actually improved the safety on Abbvie's current dividend. This platform does not want to be wrong. They don't increase or upgrade companies unless they're pretty confident that the dividend is safer over the next few years. And because Abbvie just got an upgrade this past month, even though they still have the increased debt level, even though the company is still losing Humira in 2023, it really shows that multiple different analyst firms still believe in the company long term and that the cash flow they will generate will be able to cover and continue to grow that payment even throughout the tough times. And we can see right now, the title of this article is that Abbvie's debt reduction progress strengthens dividend profile. So the CFO of this company has given a plan to continuously reduce their debt over the next few years, and different analyst firms are liking the plan they have set in place and do believe it will be very beneficial to bring the debt level back down to a much more manageable level. And if we take a look at a snippet from this article, Abbvie's current payout ratio is 41%. So that's very, very sustainable, especially within the big pharma sector. So if we take a look, even if their earnings decline through 2023 into 2024 because of the Humira loss, the company believes, and Simply Safe Dividends believes, that will of course lead to an increased payout ratio, but the overall payout ratio for that shorter timeline of decreased earnings will only go to around 60 to 65%. So that's still enough to pay down the debt, continue to grow the business, and maintain their current dividend and grow it at just an inflated payout ratio. And then going forward, as the new drugs like we saw, which are expected to generate tens of billions of dollars starting 2025, help booster up the total bottom line starting 2025 to 2030, the annual dividend payout ratio will come down, the overall dividend will continue to grow, and this massive high-yielding company will actually get through the Humira loss in a much better position than many people were expecting. So we have to take into consideration the good, their massive pipeline of products, the future growth in revenue, but also the bad, and the two main considerations are the Humira loss and the debt level. But like we saw from both of these articles from Morningstar and Simply Safe Dividends, they don't believe the negative factors are going to hurt the company too much at this current level. And if we take a look at Abbvie's income statement, year after year, total revenue continues to grow. 25 billion total sales, up to 28, 32, then 45, and now over $50 billion of total revenue in the trailing 12 months, which of course is boosted up from their recent acquisition. And overall, this company's total revenue has doubled during the past 5 years, which is a great sign. And at this current point in time, the stock is considered a buy. We have 6 strong buys, 14 buys, and 5 holds, and no one is selling out of this company. Over the past 6 quarters, they've beaten expectations every single time, and total revenue is projected to grow by 22% throughout 2021 to over $55 billion, and some more growth through 2022 to around $59.4 billion in total revenue. So definitely a high dividend paying company that's trading with a lower valuation relative to the overall market, worth taking a look at for your overall portfolio. They're a leader in the big pharma space, a massive product mix of market leading products, and going forward, they have new drugs in the pipeline, but they also have two main negatives. Their number one product is losing patent protection in 2023, and they do have an inflated debt level because of the recent acquisitions. But after taking a look at the research articles we saw from Morningstar and Simply Safe Dividends, if you believe that those two negatives will be mitigated going forward, then definitely a stock worth taking a look at for your own portfolio with some massive 4.5% current yield that will continue to grow for long into the future. So this was the first cheap dividend paying company we're going to take a look at in this episode. And now if we move on into stock number 2, its ticker QCOM, which is Qualcomm. They trade for $137 per share and are up by 51% on the 1-year chart. This is a major semiconductor player with the current market cap at $150 billion with a forward PE ratio of only 17.4, which is still below the overall market average, currently sitting around 22. They have a nice dividend yield just at 2%, so an average yield that continues to grow every single year as well. And I included Qualcomm in this video because they're on a pretty big decline as of late. From a high point at $164 per share back only in February of 2021, the company has now fallen by over 16% back down to their current level, so it might be an excellent opportunity to buy the dip on the semiconductor giant. And we can see another article from Morningstar shows that this company enjoys some nice growth from the new developments in 5G. And over the next 3 years, every smartphone manufactured will be capable with 5G technology, and as the leader in that industry, Qualcomm's expected to see some major benefits. And we can see as of April 2021, the company has a fair value estimate from Morningstar at $136 per share. And taking a look at the current share price, sitting at $137, they're trading right around their estimated fair value, which is a great sign. So you can pick up a company trading with a lower forward PE ratio than the overall market, a nice 2% annual dividend that's on a 13% decline from their high and is trading right around the estimated fair value at this current point in time compared to the entire overvalued market we sit in right now. And recently, Qualcomm has also shared some incredible financial growth. During their latest quarterly earnings, the total top line revenue grew 52% year over year. 52%. For a massive growth company worth $150 billion to continue to grow revenue at such a fast rate is absolutely incredible. And over the past quarter, they generated $7.93 billion of total sales with earnings per share of $1.90. So the total revenue growth of 52% was market beating in the quarter, and they actually outpaced many of their competitors in the semiconductor industry. And if we take a look at the company's dividend right now, with a yield of 2% and an annual dividend payout of $2.72 per share, that makes up only 35% of their net income. So at this current level, it's very sustainable with a lot of room to continue to grow that payment going forward, while also reinvesting back into the business to expand their current operations. And their 5-year dividend CAGR is at 6%, and they've been growing their dividend for 18 consecutive years, which is a great sign. And the current dividend is considered safe, and the Simply Safe dividend score comes in at an 80. So once again, over the shorter term, we're not expecting any dividend cuts or suspensions coming from Qualcomm at this current point in time. And if we take a look at their income statement, year after year, the company hovered between $22 and $24 billion of total revenue, but we can see over the past 12 months, a major expansion all the way up to $29.4 billion of total sales, and going forward over the next 2 years, this number is expected to continue to expand to over $35 billion. And if we take a look at an analyst report, they currently believe that the share price will climb to $171 per share, representing 26% potential upside from its current level. So over the next 12 months, another 27% annual expansion expected, coming from an average of 27 different analysts. And right now, the stock is considered a buy with 9 strong buys, 15 buys, 8 holds, and only 1 single sell. And over the past 6 quarters, the company continues to impress, beating on earnings in the double-digit range 5 of the past 6 reports. and annual revenue through 2021 is projected to grow by 48% to over $32.2 billion, followed by some more expansion to over $35 billion by year-end 2022. So definitely another blue chip dividend paying company in the semiconductor industry to take a look at for your portfolio at this current point in time. It's trading right around its estimated fair value according to Morningstar, with a lower forward PE ratio than the overall market, with a nice 2% dividend that's safe and will expect it to grow for many years going forward. So QCOM is the second cheap dividend paying stock worth taking a look at for your own portfolio at this current point in time. So of course today we took a look at Qualcomm and Abbvie, two blue chip dividend paying companies. Like every stock on the market, they both have their pros and their cons, but definitely worth doing some research into if you want some growing passive income into your portfolio for every quarter for long into the future. So thank you for watching this video to the end. Please hit that like button and subscribe if you already haven't done so. I'm the Gen Z Investor, and every single day we talk about the stock market, going over different stocks you can buy in any major market news. So please hit that like button, subscribe for the daily videos, and I will see you in tomorrow's episode.